And welcome back, Dan Weston's channel. All right, this is, I guess we'll call it part 2 of the Schwab ETF series. I'm kind of joking, but so SCHG will have come out before this recording, so we'll do that one, and then I'll have this one premiered, and you're watching it right now. So we will now cover the other gem of the Schwab empire, SCHG. I don't know, like people online sometimes are like, why is this one not talked about, but QQQ is? I'm like, I don't know. I prefer this one. I don't think either one's better than the other. I've chosen this one. So this isn't like a bashing QQQ thing. All right. So we're going over SCHG. So looking at their page. So things you can look for. Expense ratio. Fantastic. 0.04. You can see the index that is benchmarked, the Dow Jones U.S. Large Cap Growth Total Stock Market Index. Okay. So now this one is different. The SCHD, they take the top 100 that score the criteria they establish. This one's a little different. They don't slice off the top of whatever the methodology is. So they just take the batch, and we'll talk about it in a bit. So this is really great. So if you remember SCHD, you would think, well, that's mature, stable, older companies. So the growth fund will have a higher turnover because growth is volatile, right? Wrong. This fund is much more stable, not even 5% turnover. Very impressive. Also, that has to do with the fact it's just more, it's a bigger index, right? It's over 200. You can see here 250 holdings, where SCHD is 100 holdings. And there are reasons SCHD, with their methodology, does have more turnover. It makes sense given like investments in like freaking regional banks. We'll move on from that. All right. So this is focused. The reason I've always liked this. Now I bought SCHD was like 2018-19. I got into this. I think it was summer 20. I think it was like the end of 2020 into 2021. I became aware of this fund. So I wanted to pair my dividend fund with something growth related at the time. So, and I didn't want to do QQQ. So this popped on my radar. So this is actually a more recent thing for me. Trying to expand more into beyond just dividends. I wanted to get into something growth related to more of a degree. So here we are today. What else will I tell you? So, okay. Turnover rate 4.9. Dividend is like, I think it's like 0.4. It's pretty wild that they even, well, they pay it because to some degree they have to. So looking at what they're holding, I should stop scrolling so fast, probably making your freaking headache. So you see very heavily weighted into some of the biggest tech names you can imagine: Apple, Microsoft, Amazon, Nvidia. Very heavy market cap weightings. This is what we'll get into later. If you looking at this as part of a portfolio, all right, not just the portfolio. So this is growth, and large cap. I like the large cap part because I'm trying to stay away from small cap growth companies. I personally don't want to be part of small cap companies pretty much at all. I have mid cap exposure, large cap. Small cap, I just don't want to get around these small little speculative, unprofitable companies. Just not interested. I don't think it performs well over time, so I stay away from it. So I like that's what's appealing. What was appealing at the time is that this is large cap growth. So we'll get into what large cap means for the indices that's picking these things. So it's more diverse than you think. You think it's more restrictive being large cap. Here's the weightings. So I mean, is this a surprise to anyone? It's a growth fund. It's 44% information technology. So remember what we said. SCHD is very heavily weighted into like utilities, energy, industrials, consumer staples. So this is like literally the opposite of what SCHD is doing. It's almost all stocks. Okay, so there's the cover page. You understand. So here is the good old fashioned prospectus. So how many people do ETF reviews and ever read these things? I wonder. They just, it's like, let's review an ETF. And then everyone on YouTube is like, Okay, well, let's look at the chart. Okay, we're looking at the chart of price. Cool. We look at the top 10 holdings, which they can change every year. And then we compare it to SPY. That's like most of the ETF reviews online. Okay. Yeehaw. Get them, cowboy. Um, so this one, again, it's showing the expense ratio 0.04. There's not a lot to go over on this prospectus. Kind of light. It's not nearly as detailed as SCHD. So they tell you that it invests in stocks that are Dow Jones U.S. large cap total stock market index. That's all you get. And then Dow Jones is registered trademark. Okay. The Dow Jones Large Cap Growth Index includes components ranked 1 to 750 by full cap mark. Okay. Full market capitalization that are classified as growth. And then the index is float adjusted as of August 31st, 2022. It was composed of 222 stocks. Okay. So there you go. Same rules as CHD. They have to follow their methodology of this for 90% of the funds. And then they leave themselves that 10% wiggle room that they can do different things with. That it's the same as SCHD, basically, pretty much the same language. They can do slightly different things that are not uh, per se the exact funding use of following that index. So it's right here. I already read it in the other one. So here's the fact sheet. So this is the thing you usually get from, like, if you're an investment advisor or something, you get the fact sheet, which just gives you the very basics, top 10 holdings, market weightings, some metrics here you can look at, and then you might get some growth metrics, the turnover ratio, performance of some different time frames. I mean, that's why it's called a fact sheet. It just gives you a snapshot of what you're doing. So this one's actually not so easy to talk about, actually, because there's not a ton really on what they're doing, which it is what it is. Not everything is easy in life. So here is the index, the benchmark. There's the page. It's the same layout as the other SCHD. So we click the methodology. All right. So here's the fact sheet that they gave us again. It's a fact sheet of the indices. It just shows you a chart. All right. Just as a point of just to share, this is another revision from when I originally recorded this. If you go to the indices for SCHG, the page for Dow Jones, I will clarify. So US large cap growth index. If you go to the methodology, look at it. Global methodology. This is the wrong methodology PDF. They have the wrong one attached. I'll still link this website, and then I'll see. I think I can separately put the PDF for the right one below in the description. I'll try. So they screwed up. This is wrong. So just for that. So we go. This is the real. This is what you should look for. You could probably Google it if I can't put it in the descriptions. This is what you should look at. To understand what SCHG, the growth large cap fund, is doing. Okay, so we'll show you a few parts. It's a decent document, and this covers lots of different strategies and ETFs are doing. Okay, so right here, page 7. So this is about how they construct. Now this ties into SCHX, I think it is the Schwab Large Cap Fund. So if we look at SCHX, SCHX. So this is, so just understand, like, Standards and Poor has the S&P 500. So then now Dow Jones wants to have their own large cap, fund. They can't do the S&P 500 because they've got that down patented. So then there's, okay, we'll do the highest 750 companies in America and we'll patent that as large cap. And then there's other companies that patented the top 1,000 or 2,000. So this is what we are. So you can see 750. So this is where we start for this indices. Okay. So this talks about how they come to that. So they rank the companies in America, rank 600 or larger until automatically Dow Jones large cap total stock market index. Companies ranked 900 or higher are selected in descending market cap order until the index contains 750. So this is like how they get down to the 750 stocks that would be included in their large cap ETF. So there's our starting point for SCHG. Okay. So here's the criteria. So you can see 2 are projected forward, 2 are current, criteria and two are historical. This is a growth index, so you'd expect forward-looking, projections. So I'll point out, so you got projected price to earnings ratio based on stock's closing price time, annual review. Annual review is done in September. Okay. It's a mean annual expected earnings per share for the next fiscal period. Okay. So we got that. Projected earnings growth for 3 to 5 years. So what's nice, I've looked at other growth ETFs and a lot of them will use historical growth metrics, maybe like trailing 12 months, let's say, or they will only look 1 year into the future. So this is nice that they're looking 3 to 5 years into the future. I really like that criteria. So what are we trying to do? Why do I like this fund? We're trying to take out really small, which in my opinion are speculative growth companies that probably are unprofitable or highly volatile and have high risk of bankruptcy, because that's the business you're in with these growth companies. So I like that they're trying to weed out those companies. So Peloton, think of Tattooed Chef, think of those companies. This strategy would probably have a better chance of never bringing those in, because they had like one brief period of, like Peloton had like the 1 year period of extreme growth because of one specific event, and then since then the company's been annihilated. So we're trying to weed out those companies. That's why I like the large cap growth idea of this fund. Okay. Price to book, they look at, price to book, they look at that. I don't need comment for that. They look at dividend yields, which is kind of funny for a growth fund. It is one of the selection criteria. Okay. Cool. So they score all these. That's how they score these. And that's how they create a ranking that allows them to make their picks. This is all like methodology based, right? We're ranking stuff and we're skimming off the top what we want. Trailing earnings growth. So they do look at historical growth. They're projecting forward. Uh, so they're looking back more than trailing 12 months. They're looking back. So you can see 21 quarters look back, 3 to 5 years forward. Okay. So there's what we get. So then they take the 750 constituents of the large cap fund and they rank them. They call them, it's kind of interesting, growth or value. So that's it. It's either a growth or a value investment. So think of kind of like Moat, what Moat does. When we did the Moat video, Morningstar establishes wide moat, narrow moat, I think, or no moat. It's 3 or 4 criteria. And that's how they rank moatiness, let's call it. I like that word. So here it's just straight up growth or value. They took those 750 companies that they consider large cap, and that's it. So you can go look, the Schwab value large cap fund has like 500 stocks, and then the growth one has about 250. So there's the 750. So they take that 750 and they chop it into 2 pieces for you. Okay. So I'm interested in the growth. Now you could say, oh, Dan, well, why don't you just buy the whole thing, the 750? Great. Go. Fantastic. I have no problem with that. I don't like value, and the whole concept of value ETF baskets will be a whole nother discussion, because very unimpressive to say the least. Most of the ones I've ever looked at. So here you go. That's how they construct this. And we've already said or very low turnover, under 5% right now turnover. So these criteria don't change very often, is what it looks like. So here's the style or the components. This just talks about how they score. The 6 factors are scored, and then that's how they create their rankings, and that's what they tell you here. Weightings are market capitalization. So there you go. The only thing, reconstitute, I think it's September in here. Let's make sure. Indices are annually reconstituted in September, and then they do rebalancing quarterly. So there you go. Quarterly updates. So, and then in September is when they do this, and they do it for all their funds at the exact same time, because they're all linked here. They have to establish the 750 large cap, then they can do their analysis of value and growth, and then they can like, if I wasn't a Schwab investor, or if I didn't use Schwab for my brokerage, I could have very well paired a different growth ETF with SCHG. But it's convenient, it's all in house, and I thought it was fine. So this is one thing I liked when I originally looked at it. There's like no overlap. Okay. this was part of the reason I found this such an appealing investment for my Roth. There's like no overlap basically between SCHG and D. So very cool. Which, a lot of people, there's so much overlap in retail. They'll buy like 5 funds and they all are like 70, 80% the same stocks over and over again. So um you can look at that. You can see 4% of SCHD is an SCHG, and G has 1.7%. I mean, like, just that's good if you're going to pair these as a specific investing strategy, like I wanted. Okay. So here, I'll try and explain this. I don't really want to get into this too in the weeds, but originally, what I did, I'm trying to remember this from a few years ago. So I had taken the S&P 500 and I had identified all the S&P 500 companies that were in SCHD or G, because neither one of them is based on SPY. They're based on broader benchmarks, as we've explained, than just the top 500 companies. So I just pulled, okay, those two ETFs. I selected the ones that were in SPY, and then I'm like, okay, what is not in either one of these? And then I took those companies that were not in either one of those ETFs, and then I created a basket. And then I looked at the performance of that basket of these companies that aren't strong dividend companies that are not strong growth companies. They're like this in between, like kind of just in between the weeds to me. So I did benchmarking and they did not perform well. So here I can show, this is what I did pretty much like 2 years ago. So these are, so I have SCHD and G. I have like the top, I think it's 12. Let's see. Top 18 holdings in the S&P 500 that are not in either one of these, D or G. All right. I just even weight market cap weighted them. And then I put SPY at the bottom 100%. So if you run a benchmark for performance, you will see that actually, if we apply what time period I did 2019 to present, because that's when this kind of strategy kind of formed for me. You can see that a 50-50 SCHDG strategy has performed very well. And now I can go back and I can back test this. This is as far as my time that I've been doing this. If I wanted to back test this even further, if I went back to, usually I back test to 2010. So if I did that, um, so I'll show you that. I'm pretty sure it's the same. You get better performance. So this is something I've been kind of on to for a while now. And like I've said, I have SPY. I want to be very clear. I have S&P 500 exposure in my retirement account, my wife's. So I'm in the S&P 500. I just didn't want to replicate the exact same thing in my other accounts. I like to have diversity of ideas, and I don't like to do the same thing over and over again. So I got onto this strategy, and I'm like, I think there's something to this, that companies, I do believe, and I've shown that I believe that companies with strong dividend growth trajectories can perform very well. And I think growth can perform very well too. I just don't have a lot of growth companies. I don't think I have an edge in selecting. That's why I looked for a growth ETF like this. So I'm not totally 50-50. I do play around a bit. I'm pretty close to 50-50, honestly. So I think this is interesting. I'm not going to say it's a superior way to invest in the US market. It's interesting. It has some data. And I think you can look at some research that dividend growth companies can outperform, and growth companies, I think, have a very, even you might think right now, the markets are very hot, and we've had some great returns this year. I think the best days of the US market are not over. I think with the AI, America's going to lead in AI, cybersecurity in the US, I think is very exciting. I've talked about that in other videos. I think there's just nowhere else in the world that is going to compete with the technology that we have in the US. So the best days of the US are ahead of us, for a long time. So I don't believe the whole idea that whatever else you want to tell me. There the companies in the US that lead the way in AI and cyber security and robotics. Like, these are not in other countries for the most part. So this is kind of what I'm doing in my Roth. Like I said, I'm basically like I own like my 401ks are basically like a modified target date fund, and this is more of like a US uh f- specific strategy there. But I probably will add some other stuff. But it's kind of what I was looking to do. So here's some people, SCHG, which is funny because someone here, I subscribed to this guy, Leo Nielsen. So he kind of was on to the same idea I had, the SCHD and G combinations investment. And I've seen other people online say, well, why don't you pair SCH? Like there's different, it's the same idea though. SCHD with QQQ. It's okay, same idea. Cool. Like think about it. Or you want to be more growth targeted, you could be like QQQ and DGRO. That's cool too. You're still, it's the same principle as what I'm just talking about. Honestly, it's not that much different idea. Um, I think they're interesting ideas for investors outside of your 401k. If you want to do something a little different than just because if you got SPY already and you want to try something different, you could think about this. That's what I did. So, and then you get all the Reddit people. Well, why is no one talking about SCHG? I don't know. I really don't. I think it's a great fund. I like how it's more. I like how it's got a better expense ratio and it's a bigger basket than QQQ. Like I like that more. I'm not comparing it to QQQ today, so you can do that if you want. So that's SCHG annually in September. Freaking thing. So other than that, so final. This is a shorter video because I don't have a lot to talk about growth. Honestly, I accept that I'm not knowledgeable about growth investing, and I don't try to be. The growth. This is how I have growth investments through SCHG, and then obviously broad markets of 401k. I stick to kind of what I know. So if you're a dividend investor, this can be a way to get that exposure without really trying. Because you could pair SCHG with a growth strategy, and I think they pair well. It gives you great exposure to the U.S. market, and there's not a lot of freaking overlap. So something to think about. So here so I started doing this because I should have done this from the start. So this is how so SCHD was a satellite holding for me, is my opinion. Have whatever you want. So SCHG, surprising, I would say you could have it as a core or a satellite holding. So there you go. So it is broadly diversified. It has broad exposure. You could say it's a lot of tech, but okay. Low turnover, low expenses, large basket, right? 250 stocks. So it fits the criteria of a core investment. You could also think of it as a satellite. So you could tell me, Dan, I'm a growth investor, but what about matching VTI with SCHG? Well, you're just basically giving yourself more exposure to growth. Okay, cool. I mean, I'm not that picky, do it in a reasonable way that you can do it and stick to it. That's fine. It's your investing. So other than that, so there is that fund. There's not a lot to talk about with this one, unfortunately, to get in the weeds about. So that's about that. And then also, so Schwab does this. I'll just say that Schwab does reverse splits because these are products. This is why I like Schwab, because they're products designed for retail investors. So they try and keep the per share cost down. So when the price of the stock gets too high, they will reverse split to keep it like below $100. Whereas QQQ doesn't care about that consideration. Neither does SPY. SPY is like a commercial product, right? That's why the price of it's like $400 a share. They don't care. It's a commercial product. It's not necessarily made for a portfolio, but these are made for portfolios. So they have lower expenses. They do reverse splits because, like for Schwab, I can't buy partial shares. I have to buy whole shares every time I want to buy this. So they keep the share price down. So I like overall. That's these two. They kind of go together. Like I said, it's kind of one thesis. So I figure I'd do them together. So they'll be tied forever. So hope to hear your thoughts. Thank you. I don't know what I'll do next. It won't be another ETF. Next videos we'll figure out after New Year's or something. But thank you for listening. So this is a little additional piece. Call this an addendum. I'm going to add on to this video. So I found this art. I followed this guy. Really like his articles. So I'm just going to go through it briefly. I don't know if I clarified a few things about the actual holdings, like specifically of it. So we'll just go through this really quick. So basically, think about, they're scalping, like essentially SCHG is taking like the fifth, like 50% fastest growing portion of S&P 500 with a sprinkle of some other stocks in there that aren't. So like you can see, this is the Schwab U.S. large cap ETF. So this is the Dow Jones total market index for large cap. So they're taking, you can see 250-ish holdings are in SCHG, and then this is 750. So they're taking the fastest growing basically portion of this 750. Okay. So that's basically what you're getting. So the easiest way to think about it is you're basically just taking, slice the 750 biggest companies in the US, slice a third of the fastest growing out, or half of the S&P 500 with a little bit of extra. So that's what you're getting. Other than that, this article, pretty good. I like this guy. Follow him. He has a paid membership thing I don't do. So he's kind of what I think, honestly. If I could own just one security forever, it would be this. I'm a dividend person. I grew up as a dividend person, but honestly, if I could only own one ETF like for the rest of my life, it probably would be this one. This is in the running, honestly. I think it's just really well done. So we'll go through his article, and then I'll throw this at the end of the video. So, at a fair value or better, SCHG strategy of buying the fastest growing half of the S&P 500, it's really the 750 of the Dow, but it's not that big a difference, is unbeatable for anyone seeking zero long-term risk of losing money while maximizing long-term wealth. Because he's like what I noticed, growth is great, but you want the large, the large cap, not the small cap portion of growth for long-term stability, in my opinion. So he's also, his name's Dividend Sensei, and he's telling you this is like the one ETF he would pick the rest of his life. So that's telling you something. You have two dividend investors telling you. If you're looking for safe, and he talks about SCHD, because again, you can see that it's not that unknown. People in the know understand the combination of the two is a pretty powerful investment vehicle. So SCHG, he calls it the gold standard of growth ETFs. Interesting. Has a 5-star rating at Morningstar. It's constructed market cap weighted portfolio, fastest growing U.S. large cap stocks with low fees. Another one of the big benefits is the low fees. For something like this, it's really impressive, the low fees they give you, Schwab. So it replicates the action of Dow Jones U.S. large cap growth total stock index, which selects fast growing large cap stocks and weights them by market cap. The fund's minuscule fee, broad representation of available opportunities, low drag, provides competitive edge over its peers. The fund has outperformed the average in the category by 2.75% annualized over the past 10 years from April 2020. Okay. So now some people are like, oh, look at it. Like, oh, what are you talking about? It's very diverse. Like, I can look at the concentrations, right? You're like, Dan, what are you talking about? It's super concentrated. It's like, well, it's market cap weighted. So this is, we have some really big tech companies in America. So if you only are going in the growth aspects, it's going to be very heavily weighted into the two biggest are trillion-dollar companies, right? So, but it is diverse as far as growth companies. I mean, QQQ is not diverse. So let's compare it to what it is, right? A growth index. So I do think it is diverse for what it is. Diversity means different things in investing. So this is a diverse growth ETF. Okay. With that little piece. So he identifies two, like I already showed you in the methodology. So you have two projected, two current, and two historical. Well, we already went over this. So there's the forward-looking guidance. That's why it's a growth, ETF. So he goes, what's more, the S&P estimated 3 to 5 year forward growth estimates to determine the rankings of the fast growing companies. He's talking about like how they select SCHG. Many growth stocks use a 12-month trailing strategy, but that can result in inclusion of companies that had one great year and whose future growth prospects may suck. So he's saying looking forward more than 1 year. So he said like he likes the methodology they're using. Look no further. Oh, good example, Peloton. Yeah, Peloton was a growth company for the 1 year of COVID and then the devastation. So basically, that's why I want large cap growth, because I want to avoid investing in things like Peloton, right? That's the perfect example of what you're trying to avoid with an ETF like this. So over the last 10 years, SCHG talks about it's delivered almost 15% annual returns. Yes. Okay. So what else? Well-diversified world beater portfolio. So he's saying, why would you pick this over QQQ? He said the answer for him is twofold. It's probably similar. The NASDAQ 100 is not a growth portfolio, at least not by design. That's correct. It's just the 100 biggest companies in the NASDAQ. That's kind of where I was going to go. Like, the NASDAQ 100 is not an index, right? It's just the 100 biggest companies on the NASDAQ stock exchange. This is a specifically built growth ETF, which is, it's different. Okay. So SCHG has screeners for maximum future growth as estimated by Standards and Poor. That's why over the next 3 years, SCHG is expected to grow faster than Q. I don't know where he got that, honestly. He must have some reports I don't. So more diversified, because like 250 compared to 100 companies, lower fees. It's actually an index. It's not just the 100 biggest companies of something. So that was what he said. So he also is clear. He has Morningstar. I know that there's a lot of wide moat coverage in SCHG, which is great. Go watch my moat video if you want to hear more about moat. And I like how he uses moatiness, which makes me happy. So there's what his opinion is. So I thought I should add that one little bit. Yeah, risk profile. I mean, this is a high beta. It's like 1.2, 1 point. So this is a higher beta, more volatile stock or index compared to something like a high growth dividend. So you can go check that out. But honestly, I'm like, if you're we got into an argument during one of Strongman's live streams because somebody specifically said in the one I was on, the re-rabble, that indexes don't work for growth investors. And that really bugged me, because I'm like, and then he started like talking about PayPal. I'm like, I guarantee you I'm a better growth investor than him just by owning SCHG. I can go look at the returns. I mean, if he's been buying PayPal for a while, I've freaking crushed him. So you could be a growth investor. You don't have to, this is too easy. And then if you want to be a dividend investor, pick stocks and dividend, this still gives you that return. And gives you those aspects that you're not going to have as a dividend investor. So that's what I would tell you. What you decide to do is up to you. Okay. But I think this is a rock star ETF. It depends how you use it, right? I'm not saying this should be 100% of your total portfolio. I don't think it should, honestly. There's better ways to use this, but it's a great investment vehicle for you, I think. So, all right, that's the SCHG. Hope you enjoyed that. Like I said, as far as like evaluating the companies in there, I mean, I think I did the best I can with the growth investing. I do have another growth investment ETF now, I guess, the cybersecurity one I have. So I guess I have 2 growth ETFs, which is cool. Fine with me. All right. So that's all I got for now, and have a good day. Keep it like nice coat, white coat, how you live.